The rupee has been falling over the last 1 month compared to the dollar, from 83.48 on September 17th to 84.06 against the dollar on October 17th today. And this has been affecting the markets, or the opposite. We shall come to the impact this generates in the economy, but first let's try and understand why the rupee has been falling. Hello, my name is Abhinav Trivedi and you're watching Mint Explains. You see, the rupee's valuation against the dollar is based on the attractiveness. India is still an attractive investment destination. But on September 24th this year, something happened. China announced its stimulus package on September 24th to boost their economy by lowering mortgage rates and interest rates, which made borrowing in the Chinese market cheaper. Now, this was preceded by the US Fed cutting its key interest rates by 50 basis points on September 17th. Now, this happened after a gap of almost 2 years. Now, both these measures prompted the FPIs, foreign portfolio investors, to take their money out of the Indian equities market and put them in more lucrative options like China in this case. The selling streak by foreign portfolio investors continues to grow, with another outflow of 3,731 crores from Indian stocks recorded on Monday's trading session this week. Now, this marks the 11th consecutive day of selling, highlighting a sustained trend of bearish sentiment among international investors towards the Indian equity market. The total withdrawals over the past 11 days to 73,123 crores and 62,124 crores in October so far. Before that, the FPIs loved Indian bonds and equities and were net buyers through the year, investing almost $25 billion this year in the equities market. Most of these withdrawals are being invested where? In the Chinese equity market, in hope for better returns as opposed to overvalued Indian stocks, as some investors would say. Now, these outflows have adversely affected the Indian rupee, which has fallen to its lowest level lately. Now, FIIs too have booked profits and pulled back nearly $8 billion from the market. This has weakened demand for the rupee and strengthened the dollar. Now, experts say more sell-off could see the currency fall further, but the country's $700 billion forex reserve could come in handy for the RBI to intervene and stem the slide. Moreover, domestic institutional investors are acting as cushion by investing heavily in the market. Now, let's come to the other part of the equation. Apart from Chinese stimulus, geopolitical instability has had a major impact on the decisions of the investors. The conflict between Israel, Palestinians, Iran, and its allies, on top of the Russia-Ukraine war, could potentially disrupt global supply chain and lead to rise in oil prices. We are already seeing how oil prices are being affected by the war. Now, how does it impact you, the common middle class, the ordinary retail investor? A weaker rupee makes imports expensive, while it benefits exporters. Since India is a net importer of goods and services, a fall in the rupee has an adverse impact on a host of products, from electronics and machinery to plastics and chemicals to pharmaceuticals. Now, currently, India has a current account deficit, which is the difference between imports and exports, of $9.7 billion in the first quarter of 24-25. High rupee makes foreign education and tourism expensive. A more direct impact is on oil prices, as India is dependent on crude imports for more than 85% of its annual requirement. But you might ask, are exporters benefiting from this rupee fall? Not really. And that's the troublesome part. Since global transactions are carried out in dollars, a weaker rupee naturally makes exports more attractive, as exporters get more local currency for the dollars they earn from selling goods. But a fragile global economy means there is less demand for goods overseas, which is reflected in India's muted merchandise export growth of just 1.1% in April to August this year. While this was somewhat offset by the 11% growth in the services exports, imports are growing much faster. Volatility in the Indian stock market is likely to impact the local currency in the short term. So this trend might continue. So anything which depends on imports or their byproducts or the ingredients from auto to medicines to jewelry to electronics will likely get more expensive if this rupee fall continues, troubling the already burdened middle class loaded with inflation and high food prices. All in all, a further weakening of the rupee is bad news. Will this trend continue or not? We at Mint shall keep you posted. Please like and subscribe to Mint and please share this video for spreading more knowledge.